Trump's tax bill opened a quiet door for 88% of Americans, but if you withdraw your money the wrong way, that door slams shut. One mistake, and your Social Security could be taxed up to 85%. Trump's tax bill made it possible for millions of Americans to pay zero tax on their Social Security benefits. But here's the scary part. Most people are unknowingly making one small mistake, and it's costing them thousands. If you're already retired or planning to retire in the next few years, this message is critical for you. Let me break it down simply, clearly, and with real numbers. Part 1. What Trump's tax bill actually did. You've probably heard about Trump's 2017 tax reform, officially called the Tax Cuts and Jobs Act, TCJA. Most people think it only helped corporations or high-income earners. But buried in that law were changes that dramatically affect how retirees are taxed. Let's simplify. The standard deduction doubled. Tax brackets widened, giving you more room to stay in lower rates. And most importantly, the structure of retirement income planning became more flexible. But here's the key insight. Even though Social Security tax rules didn't change directly, other changes in the bill opened a loophole, a way for many Americans to legally avoid taxes on their Social Security benefits. Part 2. How Social Security taxes are actually calculated. The IRS uses something called combined income to determine if your Social Security is taxable. Here's the formula: adjusted gross income plus non-taxable interest plus 50% of your Social Security benefits. Now, based on this number, you'll fall into one of three categories. If you're single and your combined income is under $25,000, your Social Security is not taxed at all. If you're married, filing jointly, and you stay under $32,000, again, $0 tax. But go above those limits, and up to 85% of your Social Security becomes taxable. Now here's what Trump's bill did indirectly. It helped more people stay under those limits, especially if they plan wisely. Part 3. The one mistake that wrecks it all. Here's where the trap comes in. Let's say you've done everything right, you've worked hard, you've saved in a 401k or traditional IRA, but then you start withdrawing large amounts in retirement, or you sell stocks and create capital gains, or you start collecting Social Security while you're still working full-time. What happens? You skyrocket your combined income and boom, up to 85% of your Social Security benefits get taxed. This is what's called the Social Security tax torpedo, a chain reaction that hits retirees the hardest. One wrong move, and that quiet door Trump's bill opened, it slams shut. Part 4. Who qualifies to pay $0 in Social Security tax? Let's talk about the 88%. Who are these people that could legally avoid taxes on Social Security? They're not just low-income Americans, they're smart planners. Here's what they do. They use Roth IRAs or have done Roth conversions, which don't count toward combined income. They delay claiming Social Security until age 67 or 70. They rely on tax-free municipal bond income. They keep their retirement withdrawals strategic and limited. They take advantage of the standard deduction each year. If you combine these tactics, the IRS sees very little taxable income, which means Social Security stays untouched. And yes, it's 100% legal. Part 5. 5 powerful strategies to stay in the 88%. Let's get tactical. Here are 5 practical ways to avoid Social Security taxes. 1. Use Roth withdrawals. Money pulled from Roth IRAs isn't counted in your combined income. 2. Delay Social Security until full retirement age or later. Waiting until age 67 or 70 not only increases your benefit, it also avoids overlapping with earned income or RMDs. 3. Move to tax-free interest sources. Municipal bonds offer tax-free income that doesn't show up in the IRS calculation. 4. Draw down traditional IRAs. Before 73, strategic withdrawals in low-tax years reduce required minimum distributions, RMDs, later, keeping income below key thresholds. 5. Use QCDs, qualified charitable distributions. Once you turn 70, 2, you can donate directly from your IRA. This counts toward your RMD, but doesn't show up as income. These aren't loopholes, they're IRS-approved methods that smart retirees use every day. Part 6, Why Most Advisors Don't Talk About This. Here's the sad truth. Most financial advisors don't even mention Social Security tax planning. Why? Because they're focused on growing your portfolio, not optimizing your withdrawals. They chase market returns, not tax efficiency. But guess what? In retirement, it's not about what you earn, it's about what you keep. This is where the 88% win, and you can be one of them. Empowerment. Let's bring it full circle. Trump's tax bill quietly opened a door for everyday Americans. Not just the wealthy, not just the insiders. 88% of Americans now have a legal path to pay $0 in Social Security taxes, but only if they avoid one mistake, the kind that slams the door shut. So ask yourself, are you blindly following outdated retirement advice? Or are you ready to take control of your tax future? Be one of the smart 88%. And if no one's told you this before, let me be the first. You have more power than you think. Subscribe for more real money insights the IRS doesn't want you to hear. This is Elyze. See you in the next one.